Good evening, taxpayers. It's Tuesday. And as promised, I'm delivering content this evening that is aimed directly at tax preparers. And if you are wondering what qualifies me to educate tax preparers, with myself being a tax preparer, I will tell you that I am a former IRS agent who used to actually assess penalty against tax preparers in the field, visiting the tax offices to audit your files, the tax preparer's files, and also as a former IRS appeals officer who would work on the appeal for those penalties. So my education and knowledge of the IRS requirements under Circular 230, Internal Revenue Code 6695 for due diligence, and other penalties for, I'll just use the term for the lack of being conservative, as you should be under Internal Revenue Code 6694. I am a former IRS agent who assessed those penalties to individuals and who also appealed those penalties or took a taxpayer through the appeals process and settled those cases for the United States Tax Court. So I'm more than qualified to educate you about what the IRS requirements are. And before we get started, just know that there are tax attorneys out there. If a tax preparer is assessed a penalty by the IRS, there are attorney representatives out there who could assist you with fighting that penalty, whether that was through audit, through appeals, or through tax court if your case went to that level. But then there's also us, who we know it like the back of our hands because we have internal knowledge, and so do the other IRS attorneys who offer the service of assisting tax preparers with working through the IRS system to be relieved of those penalties. If you are assessed, they are hefty penalties. There's $505 penalty assessment for each occurrence on a tax return, and you could have 3 to 4 errors on one tax return and easily incur a $2,000 penalty just for that one tax return. So here at Tax Technicians, where we can be reached at 281-762-2189, we'll give you a free assessment and help you with your case, and for a lot less. So let's just dig right in. We're going to talk about the how do you incur the penalties? You incur the penalties in a few ways. We're going to talk about the biggest way, which is due diligence under 6695, where you're being assessed the penalty for lack of compliance, where the earned income tax credit, child tax credit, and those associated refundable credits are involved. But let's also talk about tax preparers who, when you're preparing a tax return, just ensure that whatever the issues are of the tax return, like let's just use a 1031 like-kind exchange as an example. If you've never done a 1031 like-kind exchange return, let's say you won't get a penalty for doing one of those if you do it incorrectly, but if you develop if you develop by word of mouth, receiving clients, if you've done one and then you do a few, but you don't have the expertise to work a return at that level, it's best that you just either refer it out and work with whoever the tax preparer is that you're referring it out to that has that expertise, because it's not worth, if you develop a pattern of doing tax returns that you don't have the level of education for, you could be penalized because the IRS they pull one of your tax return, or if they identify one of your clients by way of audit having a lot of errors, that could open you up as a tax preparer for a tax preparer examination of the tax returns that you prepared, especially if those errors were egregious errors. And what that means is that your errors on the tax return resulted in a large deficiency of tax to your client. Okay, so just be aware of, if you don't have the education to work a return because it's a little more complex than what you're used to, or it has a level of complexity that you've never worked before, it's okay to refer it out, or just educate yourself as much as you can to make sure it's done accurately. Then there's patterns. I talk a little bit about that, where the patterns exist. And what I mean by that is tax preparers who their tax returns are getting a lot of audits. They're being flagged. They have large deductions that are questionable, that seem out of place. It could be, well, Schedule A, a lot of things on Schedule A have been taken away. Schedule A was one of the areas or one of the schedules where the IRS would identify a lot of error or patterns of error. And then also on the Schedule C, it could be Schedule E. But if enough of the tax returns that you've prepared have a pattern of overstatement, so it seems, then that's one of the things that will definitely get a preparer examination or preparer audit assessed against you and get all of your tax returns audited. And then you would be defending yourself against not just one client, but all of your clients if they find errors on those tax returns, or if they identify patterns of overstatement of deductions or credits or dependence on those tax returns. Then we talked a little bit about the earned income tax credit or the refundable credits and the Internal Revenue Code 6695 due diligence requirements and Circular 30. Familiarize yourself with those. If you need help understanding what the requirement is, we can help you with that here. Primarily documentation. You have to keep it in your file. But I know what those files should look like, and if you are audited or if you are caught off guard, which you shouldn't be caught off guard because the IRS always sends you a letter, if they ever send you a letter and that they will be in your area to your office to review your files, then start preparing yourself and don't wait till the last minute, even if you have to reach out to us or a tax attorney of any kind for help. Just know that if they flagged you, they already have a reason. So one of the, speaking of where they find the most error, the most, overstatement or the most potential for overstating deductions is the Schedule C. Or for earned income tax credit, it's not even overstating deductions, but it's the fake Schedule C. It is reporting self-employment for the purpose of increasing the income so that the taxpayer can qualify for the maximum earned income tax credit. Oldest trick in the book, easy to flag by the IRS, easy to determine. The biggest penalty potential is there where there's low W-2 wages. And so if you've learned how to do this from some other preparer or the tax preparer agency that you've signed on to because everyone else is doing it, I would strongly suggest and encourage you not to do that. Not only will you receive a penalty, all of your returns will be flagged, you'll receive all the penalties, your preparer tax ID number will also be pulled, and you will no longer have the potential to earn money during tax season. And if that's your primary job for tax season, or for, a lot of big agencies, they make, really good money during that time. So if you're working for a big agency and there's a trend of just, inflating income by using the Schedule C because the taxpayer may not qualify for the maximum earned income tax credit, it's a bad idea. This is why the IRS is putting foot soldiers. They've ramped up collection efforts. Well, they've hired in the collections division or in the field incentive division. Most of it is collections, but I doubt seriously that they didn't put some foot soldiers in the budget to make the scheduled field visits, and they do this during tax season. So of course that's when they can audit your files. That's when your files are available, accessible. That's when you are accessible. So while you're in your office during tax season, working away, you could easily get a letter from the IRS saying, oh, guess what? While you're busy and your calendar is full, make enough room for us to audit you. So that's why it's just better to keep your nose clean. What else did I want to give you? Cash-based taxpayers, easy to flag. Speaking of the Schedule C, the self-employment income again, where the Schedule C is just made so that the income level can be increased so that the credit is increased, and it's mostly cash-based taxpayers. Unlicensed individuals, babysitters, hair braiders, hairstylists, at-home businesses, no brick and mortar, no business bank account, no deposits of the cash. So these are for cash-based businesses where the Schedule C, I'm myself personally, if I get a client, a potential client that is self-employed and working from the home, or working in a business where they receive cash and they don't deposit those receipts, those cash receipts, into a bank account. They don't have a business bank account. They don't have business cards, business flyers, business advertisements, a business phone number. They have none of those things, but they're filing a Schedule C. Then there is potential that they're not reporting all of the cash. They're only reporting enough to qualify for the credit, and the IRS is aware of this. So just know, and that's one area. That's one of the biggest areas of potential tax preparer penalty, and also dependents that are not, claiming exemptions for or claiming dependents where the individual is not the custodial parent or one of the custodial parents. There's more documentation, or more documentation, more I want to say interrogative questions that you should be asking those taxpayers that should be documented. So when I say documented, I mean document on paper, in terms of having the documentation that that person is the rightful, is the custodial caregiver, because they're not the custodial parent, but are they the custodial caregiver? Have enough documentation that proves that in the file, but also in your check sheets. Have enough language that you ask the probing questions to say, yes, you did certify that the information is accurate. And if you've done that, then you should be okay with, having the required amount of proof. No proof of expenses, things like that. I could go on. I don't want to make this too long, but there is an area where the IRS is, they know all the tricks that have been done. So, and of course, the taxpayer, the practitioner public, sometimes, they invent more, but it's not worth it. It's not worth getting your P-10 pulled. And those penalties are so hefty. They're $10,000, $20,000, $30,000, $70,000. It's just not worth, getting a refund for someone. First of all, they're going to have to pay it back with interest and penalties, and then you'll have penalties. You guys have questions about this, and you want to know more about due diligence, Circular 230, 6695, 6694 penalties for preparers, don't hesitate to give us a call, and we'll be here to help you. Thank you.